I want to give a little bit of context in the background for capital markets in general, where Wall Street and capital markets as we know it, from after the Depression in 1929 to 1970 roughly, markets were very boring. It was just like accounting. Banks and speculative investing were totally separate, and there were all these rules and regulations. In the 1970s, there were two key things that happened. We deregulated capital markets and allowed for a lot more speculation, which is good. And we also, Milton Friedman created the Friedman doctrine of businesses no longer exist for the sake of the community. They exist for the sake of the stockholder or the corporation. It's the stockholder versus the stakeholder. And that gave companies like Enron the permission to take very wildly risky bets they could justify because it would make stockholders more money, even if it hurt the community. And the deregulation allowed for the financialization of our economy that had never existed before. And so for the first time from 1970 to 2010-ish, or even 2020, over these 50 years, prior to that, every big market move was primarily a geopolitical event. And since then, every big market correction has been a finance-driven or a market, like a Wall Street-driven event. And you can look at stagflation, you can look at the housing bubble, you can look at the tech bubble, and increasing the amounts of leverage and the riskiness of those bets had created this industry of, there's a great chart that I'll share where you can watch the pay like go steeply parabolic from 1970, where it used to be full parity with the rest of the economy. And then Wall Street's pay became like 10x more than the regular economy. And for the first time ever recently, and by the way, over the past 20 years as retail investing became a thing, there is this, in my opinion, nefarious narrative that is very paternalistic, as you said, which is markets are way too risky for the regular person to do. It's too complicated. You don't really get it. Give me your money. We will manage it for you. And yeah, sure, we'll take a little bit off the top. What I think is the most fascinating of this paternalistic permission, as you said, the permission to invest thing, is when you step back and realize, hang on, so what you're asking is for us to concentrate all of our money into your account so that you get to make more money off of it. And it creates this kind of rampant inequality that's been running for the past 50 years. But by the way, you keep screwing it up too, and this is a gross generalization, but as a whole, institutional investors are the ones that get over-levered or overly concentrated their risk and cause these crashes. Distributed retail investing has never caused any sort of massive market correction or recession because that risk is distributed healthily amongst millions of people. And so what finally has happened over the past few years is, in a very large way, people realizing, hang on, for the first time ever, I can take control of my own finances. And also I have an informational advantage because I have boots on the ground and I know what products my friends are using. I know what products I myself am using, and I want to invest in the things that I believe in. And that is almost more valuable than what the CNBC or Bloomberg or the fund manager tells me I'm supposed to invest in or how I'm supposed to invest. And it's evolving very rapidly into crypto and NFTs. And so I think that we're seeing this kind of brand new approach where the vast majority of people have realized, wait, I don't need permission to do this. The pernicious narrative of a pat on the head, this is too risky for you, regular people shouldn't be allowed to do this, has been turned on its head and realized from the data we see on Commonstock, self-directed investors actually outperform the hedge funds over the past few years. And who's to say whether that trend sticks, but I think it will. I think we've seen a totally foundational change in the way that markets operate because there's been this influx of new capital where self-directed investors have gone from under 5% to over 30% of the market. And that is unbelievably healthy. Instead of concentrating in the entire market by volume in a few institutions, it's now being distributed back to the vast majority of people all over the country and world who get more direct access and don't have to pay a fee for somebody who is, at the end of the day, just going to put them into an ETF that reverts their performance right back to the mean. And by the way, this opens the can of worms that I also believe is that I'm not saying that you should never let professionals handle your money. I'm just saying there is a difference between not giving permission to regular people to invest versus acknowledging it's healthy to have some of your money in a self-directed brokerage, because we need people to get exposure to how businesses and markets work. My very hot take in all of this is the value of markets is much less the dollar size of your portfolio, but the knowledge that you gain over the years that compounds. And so starting at 20 and understanding inflation, the fact that there are teenagers on TikTok talking about Jerome Powell and the Fed is mind-boggling, where usually that conversation wouldn't happen until you're well into your 30s or 40s. And so if that knowledge compounds for that generation of people, I think for the first time, people have realized they don't need permission to be engaged with that type of knowledge and to make moves based on it. So I can keep going forever on this, and I know I'm probably rambling. It's so exciting for me to see en masse, to see people realize the traditional gatekeepers of access to this upside have been bumped out of the way, and that there's still a very important, healthy place for institutions in capital markets, but it's very healthy for regular self-directed investors to make up a very large portion of capital markets. That's the way it has been prior to 1970, and the pendulum is swinging back to that right now, which the people who craft the narrative because they run these funds and are incentivized to manage that money and get those fees are going to continue saying, this is too risky. This is all examples of things that are too dangerous. But the data that we see is actually counter to that, which is regular self-directed people are making intelligent decisions with their money. They're not like putting their entire net worth into the riskiest asset all at the same time. That's not an actual thing that's happening. They might buy 1 or 2 shares of GameStop to participate in a Six Sigma event, but they're going into that eyes wide open, knowing I want to have a little bit of exposure to this very high risk thing. It might be a fraction of a percent of my portfolio, but the upside of that, just like classic portfolio theory, the upside of that is asymmetric. And I have the vast majority in professionally managed 401ks or passively managed ETFs or indexes. And it's actually a very thoughtful, intelligent approach that we're seeing, at least. And I think it's really exciting to see that happening.